So the data that you're going to see today is actually coming from the option chain of futures, and in particular, we're going to look at crude oil and gold. But if we look first the price, so what we've seen from a macro standpoint over the past few days and few weeks, we've seen an increase in the price of crude oil, breaching the $80 level right here. We've seen like a small retracement over the past couple of days, and now we're still kind of like going towards that 80.79 level. So if we look at what's happening in the crude oil space, mostly is due by the macroeconomic events, obviously the supply chain risk and what is happening in the Middle East. This is really driving the price. We've seen from in the past like a surge in call option activity and a significant increase in out-of-the-money call options, especially on WTI and Brent futures, and mostly has been driven by the macro environment, by the news, and by the volatility in the market. So obviously, why do traders look at out-of-the-money call options? So first is really the volatility factor. So they are placing directional bets, but they're also placing volatility bets. So always think that the key factor in the option pricing is obviously the underlying price, the volatility, and time, right? So obviously time to expiration is important, because if you have out-of-the-money options, then theta has a bigger effect if the price doesn't reach that strike by the expiration. But also volatility is very important. So traders are using out-of-the-money options because they are cheaper, and they are betting on the increase or decrease in volatility, so the change in volatility. By using out-of-the-money option, they are paying less premium, and they potentially could benefit not only if the price of the underlying goes to the direction of the strike, but also if the volatility shifts and obviously the time to expiration. So obviously they are betting on that. So how can we see that? So if we go back into our bot, first of all, we can look at, let's start with the December contract on crude oil. We can look at the volatility and open interest, and we can kind of go back in time and see, basically, we see a lot of, like, as you can see, a lot of green here. So most of like the open interest is kind of like on the call side. Here we see also the volume on the right-hand side, and we can go back in time up to 5 days to analyze, how this has changed. So here we see, for example, that we had more like red bars towards that lower part. And if we go back to the futures date, we see that, obviously there's a shift there. The second thing we want to do is we want to look at gamma, right? So we can use our net gamma exposure chart, and we can look at CL. We open the December contract, and we can see basically the gamma exposure here. So here we see that we have our core resistance is at the 80 level. We also have a big really level here at 75, 74. Our high vol level is at 70. Here you see the positive net gamma exposure, and we have our put support here all the way down at 65. We can also go back in time and see how things have changed. If you see, can you spot more like green bars, more red bars as the positive or negative jacks change over time. And then we can also do the same thing with our multi-expiration. So we can look at different expirations in the chain, and we can see kind of like if the picture is similar, even if we go at different expiration in the future. So monitoring this is very important. Then what we can do is we can look at also what is happening. So we've seen a big flow coming in from the algorithmic trading funds, in particular the CTAs that have been adding long positions, boosting kind of like the price. So we saw, for example, a big surge in kind of like the Brent crude oil above the $80 due obviously to the macroeconomic events. And a lot of that has been driven by CTAs. For those who don't know what CTAs, there are systematic strategies that are using like, technical indicators and, price action to kind of like determine their strategy. So what we do have here is we have our CTAs model, and we can look at different assets. We can look at gold, we can look at treasury. Let's look at Brent right now. So if we look at our Brent oil here, we can see that the green, so the white line is the price of Brent, and the green line is kind of like the positioning of CTAs. And obviously this kind of spike in positioning has also contributed to the increase in price. So here we see how that has changed over time. So all of these models can be found right here, and we also do the same for WTI right here, similar picture. We can look at that. Then we can also show you gold and silver in a second.